Something strange is happening in the markets right now. 3 companies, 3 completely different industries. No obvious connection. Yet all of them are falling at the same time. PayPal, Walmart, AMD, a fintech giant that once symbolized the future of digital payments. The world's largest retailer, a company that touches the daily life of millions of Americans. And a semiconductor powerhouse riding the artificial intelligence wave. Different businesses, different customers, different risks. So why are they all breaking together? This isn't a coincidence, and this isn't just about stocks going up or down. This is how cracks form inside a system before people realize something is wrong. Because real market crashes don't begin with panic. They begin quietly, with leaders weakening, with signals most people ignore. And today, those signals are everywhere. Let's start with PayPal. For years, PayPal was seen as untouchable. It wasn't just a payments company, it was infrastructure. Every online transaction, every digital checkout, every global transfer made PayPal feel like a toll booth of the internet. Money moved and PayPal collected its cut. Investors loved it. Growth was explosive. The narrative was simple. Cashless society, digital wallets, endless expansion. But then something changed. User growth slowed. Transaction margins shrank. Competition exploded. Apple Pay, Google Pay, Buy Now Pay. Later services, fintech startups. Suddenly PayPal wasn't the only option anymore. And worse, people weren't spending the way they used to. This is the part most people miss. PayPal doesn't fall because of bad management or missed earnings. It falls when consumers stop clicking Buy Now, when people hesitate before spending, when discretionary purchases dry up, when impulse buying disappears. PayPal is not a tech stock, it's a consumer behavior stock, and right now consumer behavior is changing fast. Credit card balances are near record highs, savings are shrinking. Buy Now Pay. Later defaults are rising. People are still buying essentials, but they're pulling back on everything else. And that brings us to Walmart. If PayPal shows you what people do online, Walmart shows you what happens in real life. Walmart isn't a luxury retailer. It doesn't depend on trends or hype. It survives recessions because people always need food, groceries, basics. For decades, Walmart has been considered one of the safest stocks in America during uncertain times. So when Walmart starts sending warning signals, smart money pays attention, and those warnings are now impossible to ignore. Walmart has been very clear in its messaging. Consumers are under pressure. Shoppers are trading down. They're buying cheaper alternatives. They're prioritizing food and essentials over discretionary items. Higher income customers are behaving like lower income customers. This is not normal. When inflation hits hard, people don't stop spending immediately. First, they switch brands. Then they reduce volume, and finally they stop buying altogether. Walmart is seeing the first 2 stages happen right now, and this matters because Walmart sits at the center of the American economy. Millions of transactions every single day. Millions of data points. When Walmart says the consumer is stressed, it's not an opinion. It's a measurement. Now here's where it gets interesting. While PayPal and Walmart reflect consumer weakness, AMD represents something else entirely. Expectations. AMD has been riding the AI boom. Investors poured money into anything connected to artificial intelligence. Chips, data centers, cloud infrastructure. It didn't matter. If AI was mentioned, valuations exploded. AMD benefited from this wave massively. The story was clear. AI demand will grow forever, and AMD will be one of the winners. But markets don't move on stories forever. They move on results. And slowly, reality started to catch up. Competition intensified. Nvidia remained dominant. Margins became a concern. AI spending, while massive, became more selective. Companies started asking tougher questions about ROI. And suddenly, the market realized something uncomfortable. AI isn't collapsing, but the AI hype curve is flattening, and when expectations come down, prices follow. AMD's decline isn't about failure, it's about future growth being repriced. This is a key point. PayPal shows consumer weakness. Walmart confirms consumer stress. AMD reflects declining confidence in future growth narratives. Different signals, same direction. Down. Now step back for a moment. When was the last time you saw consumer spending weaken, essentials retailers warn, and growth stocks reprice at the same time? It happens at inflection points, moments when the economy quietly shifts gears. This is what system-level cracks look like. Liquidity tightens. Interest rates stay higher for longer. Borrowing becomes expensive. Companies slow hiring. Consumers rely more on credit. Profits compress. Expectations reset. Nothing breaks overnight. Instead, leaders start falling first. And that's exactly what we're seeing. The dangerous part is that most people are still distracted. Markets are still up in some areas. Headlines talk about resilience. Optimism remains in pockets. But under the surface, pressure is building. This is not fear-mongering. This is pattern recognition. Look at history. Before major downturns, the first signs never come from the weakest companies. They come from the strongest ones losing momentum. In 2000, it was tech leaders stalling. In 2008, it was housing and financial infrastructure. In 2020, it was global supply chains snapping. Today, it's consumption, payments, and growth expectations cracking simultaneously. That combination is rare, and it matters because the US economy is built on consumption. If consumers slow down, everything else follows. Profits fall. Hiring slows. Investment drops. Markets adjust. And here's the part most retail investors underestimate. This doesn't require a recession headline. Markets don't wait for confirmation. They move on anticipation. PayPal doesn't need a collapse. Walmart doesn't need losses. AMD doesn't need failure. They just need the future to look slightly worse than before. And right now, it does. Another important signal is timing. These declines are not happening years apart. They're happening together, within the same cycle, under the same macro conditions, high interest rates, persistent inflation pressure, geopolitical uncertainty, tight financial conditions. This environment exposes weakness faster than people expect. Easy money hides problems. Tight money reveals them. For over a decade, cheap capital allowed companies to grow aggressively, acquire users, expand margins, and push valuations higher. That era is over. Now every dollar matters. Every customer matters. Every margin point matters. And not everyone survives that transition unscathed. This doesn't mean the market is about to collapse tomorrow. It means the system is under stress. And stressed systems behave differently. Volatility increases. Narratives change faster. Leadership rotates. What worked before stops working. This is why investors feel confused right now. Why good news doesn't always push stocks up. Why bad news hits harder than expected. The rules are shifting. And PayPal, Walmart, and AMD are early indicators of that shift. One shows you spending behavior. One shows you economic pressure. One shows you expectation reset. Together, they tell a story most people aren't ready to hear. The market isn't breaking yet, but it is cracking, and cracks spread. They move from one sector to another, from consumers to companies, from profits to valuations, from optimism to caution. The question isn't whether this matters, the question is how prepared people are when the pressure increases. Because by the time everyone agrees there's a problem, the opportunity and the warning is already gone. This is how downturns begin. Quietly, unevenly, and right in front of us. And there's one more layer to this story that most people completely miss. Markets don't just react to numbers, they react to psychology. Right now, psychology is shifting. For the last few years, investors were trained to believe one thing. Bad news is temporary. The Fed will save us. Liquidity will return. That belief created a reflex. Every dip was a buying opportunity. Every correction was ignored. Every warning was dismissed. But that reflex is slowly breaking. When PayPal drops after earnings, it doesn't bounce like it used to. When Walmart gives cautious guidance, the market listens. When AMD misses expectations, AI hype doesn't protect it anymore. That tells you something very important. Confidence is no longer automatic, and once confidence becomes selective, markets become dangerous. Because selective confidence means investors start asking questions again. Real questions. Is growth actually sustainable? Are margins real or financial engineering? Is demand organic or credit-driven? Is AI a productivity revolution or just capital expenditure inflation? These questions didn't matter during easy money. They matter a lot now. Another hidden connection between PayPal, Walmart, and AMD is exposure. Not to the same sector, but to the same economic cycle. PayPal is exposed to online discretionary spending. Walmart is exposed to household budget stress. AMD is exposed to corporate investment confidence. When all three weaken together, it tells you the cycle is tightening from multiple directions. Consumers are cautious. Households are stressed. Corporations are careful. Right now, the direction is clear. Less excess, less forgiveness, less hype, more scrutiny, more pressure, more realism. The market is not collapsing, but it is no longer forgiving mistakes. And that alone changes everything. Because markets don't crash when everyone is scared. They crack when everyone is still pretending they're not.